Right now, while you're watching this video, a $7 gap has appeared in the silver market that should not exist. Chinese factories are paying nearly 10% more for physical metal than what your trading screen shows. And somewhere in New York, a margin clerk just calculated that if silver crosses $35, $25,000 per contract, multiplied by tens of thousands of positions, equals a forced liquidation event that could rewrite the global financial order. The arbitrage traders see it, the algorithms are screaming, but the metal isn't moving, which means only one thing. Welcome to Currency Analyzer. You know, when I speak with gentlemen of experience, those who've seen markets rise and fall over decades. They tell me something profound. The most important information always comes right before everyone else realizes it. So if you value being positioned ahead of the crowd, if you appreciate analysis that respects your time and intelligence, I'd be honored if you'd subscribe to this channel. Just press that button below, the way you'd bookmark a page worth returning to. And please, tell me in the comments, where in the world are you watching from today? Because what's unfolding in the silver market doesn't respect borders. Now, let's examine exactly what's happening. On the morning of January 2nd, 2026, a commodity trader in Singapore opened his terminal and noticed something that made absolutely no sense. Silver was trading at $71 per ounce in New York. The exact same silver, the exact same purity, the exact same delivery specifications was trading at $78 per ounce in Shanghai, a $7 difference. In normal markets, this gap would last approximately 4 minutes. Arbitrage traders would see the difference, buy low in New York, sell high in Shanghai, and pocket the spread. The gap would disappear as fast as it appeared. But this gap wasn't disappearing. It had been there for 6 weeks, and it was getting wider. The trader leaned back in his chair and realized he was witnessing something that textbooks said shouldn't exist, a persistent arbitrage opportunity in one of the world's most liquid commodity markets. But markets don't lie for 6 weeks straight. When an arbitrage gap refuses to close, it means one thing. The product can't move from point A to point B, either because it physically doesn't exist, or because someone is blocking the exit. The Shanghai Gold Exchange, where physical silver changes, hands in China, had been showing premiums over Western prices since late November. At first, traders dismissed it as year-end positioning. Then it was Chinese New Year buying. Then it was industrial restocking. But by early January, the explanations had run out. The premium was now structural. A research analyst in London pulled up the inventory reports from COMEX, the New York exchange where silver futures trade. The numbers told a disturbing story. Registered silver stocks, the metal actually available for delivery, had fallen 34% in 8 months. Meanwhile, open interest, the number of contracts obligating delivery, had barely moved. The math was simple and terrifying. More claims on silver existed than actual silver available to deliver. In Shanghai, the situation looked completely different. Chinese industrial buyers weren't trading paper contracts. They were taking physical delivery. Every ounce, every shipment. No speculation. No leverage, just metal moving from vault to factory. And those factories needed silver desperately. Because China had built something the world hadn't fully recognized, a complete monopoly on solar panel production. 83% of every solar panel manufactured on Earth came from Chinese factories. And every single one of those panels required approximately 1 ounce of silver per unit to function. The silver paste that conducts electricity from silicon cells, irreplaceable, non-negotiable, absolutely essential. Chinese manufacturers were consuming roughly 130 million ounces of silver annually just for photovoltaic production. Add in electronics, 5G infrastructure, and electric vehicle components, and the number climbed past 200 million ounces. That was half the world's annual mine supply, going to one country. For industrial use that couldn't be delayed or substituted, an economist in Beijing reviewing internal government documents noticed something else. In December 2025, Chinese customs authorities had quietly implemented new export licensing requirements for processed silver products. The paperwork wasn't complicated, the delays weren't extreme, but the message was clear. Silver entering China would face significantly more friction trying to leave. It was economic statecraft disguised as bureaucratic procedure. And it was working. Western traders could see the Shanghai premium. They could calculate the arbitrage profit. Some even tried to execute the trade, buying silver in London or New York and shipping it east. But the metal wasn't arriving in time. Shipping delays, customs inspections, documentation requirements. By the time the silver cleared Chinese ports, the premium had shifted, or the buyer had sourced locally, or the trade no longer made economic sense. The arbitrage opportunity existed on paper, but in reality, the metal was trapped. The Singapore trader closed his terminal and walked to his window. Somewhere across the Pacific, vaults in New York held silver certificates representing metal that might not exist in deliverable form. Somewhere below him, Chinese factories were running 3 shifts producing solar panels that would power the next decade of global energy infrastructure. And in between those 2 points, a $7 gap that refused to close. The market was trying to tell anyone willing to listen a simple truth. The paper price and the physical price had separated. And when 2 prices exist for the same asset, only one of them is real. The question wasn't whether the gap would close. The question was which price would survive. In a glass tower overlooking the Chicago Board of Trade, a risk manager received an alert that would keep him awake for the next 72 hours. Silver had just closed at $34.80, 20 cents below a number that could trigger financial chaos. The number was $35, and it wasn't arbitrary. Buried inside the rulebook of COMEX futures, trading set a mechanism that most investors never thought about, the maintenance margin requirement. It's the amount of cash a trader must keep in their account to hold a futures position overnight. For silver, that number scaled with price. At $30 per ounce, a trader holding 1 short contract, a bet that silver would fall, needed roughly $18,000 in their account as collateral. At $35 per ounce, that requirement jumped to $25,000, a $7,000 increase per contract. Now multiply that by scale. According to publicly available data from the Commodity Futures Trading Commission, commercial traders, primarily bullion banks and institutional hedgers, held short positions representing approximately 400 million ounces of silver. That translated to roughly 80,000 contracts. If silver crossed $35 and stayed there, those institutions would face margin calls totaling $560 million within 24 hours. But that was just the beginning. Because markets don't move in straight lines when forced liquidations begin. They accelerate. A trader forced to cover a short position must buy silver. That buying pushes the price higher. Higher prices trigger more margin calls. More margin calls force more buying. The feedback loop becomes self-reinforcing. A quantitative analyst in London had modeled this scenario 3 months earlier. His spreadsheet showed that if silver sustained a move above $37, the cascade could push prices to $50 within a week. Not because of fundamentals, not because of supply and demand, simply because of the mechanics of leverage unwinding. His report was filed and never discussed again, until now. The situation bore uncomfortable similarities to historical market dislocations. In 1980, the Hunt brothers attempted to corner the silver market. When margin requirements suddenly doubled, they couldn't meet the calls. The forced liquidation crashed silver from $50 to $11 in 8 weeks. But that was a speculative bubble created by excessive leverage on the long side. This was different. This time, the leverage sat on the short side, and the shorts weren't speculators gambling on price declines. They were commercial banks hedging physical inventory, mining companies locking in future production, and financial institutions providing liquidity to derivatives markets. These were positions that couldn't simply be abandoned. In 2008, palladium provided another case study. Russian supply disruptions created a physical shortage while paper markets remained heavily shorted. When industrial buyers rushed to secure metal, the price went from $180 to $600 in 6 months. Several trading desks took catastrophic losses. 2 smaller banks required emergency liquidity support. Palladium's entire market was roughly $4 billion at the time. Silver's market was 10 times larger and far more interconnected. A compliance officer at a major European bank pulled up their institution's silver derivative exposure. The numbers were classified, but she had access. Her bank held short positions across futures, options, and over-the-counter swaps representing 18 million ounces. At current prices, those positions showed a modest profit. At $50 silver, they represented a $340 million loss. At $75 silver, the loss exceeded the bank's quarterly earnings. At $100 silver, it became an existential threat. She drafted an internal memo recommending the immediate reduction of silver exposure. It was reviewed, debated, and ultimately shelved. The reasoning was simple. Unwinding large positions in an illiquid market would itself move prices against them. They were trapped by their own size. The Bank for International Settlements, the central bank for central banks, published its quarterly derivatives report in December. Buried on page 47 was a table showing precious metals derivatives exposure across reporting institutions. The notional value had increased 23% year over year. But open interest in physical markets had barely moved, which meant the leverage had increased. More claims on the same amount of metal. The risk manager in Chicago scrolled through his position reports. His firm wasn't a major player, just 2,000 short contracts. But even that modest position would require $14 million in additional margin if silver crossed $35. His firm had $9 million in liquid reserves. He picked up the phone to call the CFO. Across the global financial system, similar conversations were beginning to happen. Quietly, privately, without alarming clients or triggering regulatory scrutiny. because admitting the problem publicly would accelerate the very crisis they feared. The derivatives market had created a situation where everyone knew the risk existed, but no one could act without triggering the event. It was a financial standoff, and silver was 20 cents away from breaking it. The question wasn't whether someone would blink. The question was who would blink first, and what would happen when they did. In the high desert of Peru, 14,000 feet above sea level, a mining engineer stood at the edge of an open pit and did calculations that didn't add up. His company had been extracting silver from this mine for 43 years. Last year, they pulled out 8.2 million ounces. This year, with the same equipment, the same workforce, and higher silver prices that should have justified expansion, they would extract 7.1 million ounces. The ore grade was declining, and no amount of money could reverse geology. This wasn't unique to Peru. Across Mexico, Bolivia, and Chile, the world's primary silver-producing regions, mine output had flatlined. In 2016, global silver mine production peaked at 900 million ounces. A decade later, despite higher prices and technological improvements, that number had barely moved. Some years it declined. The reason was buried in the nature of silver mining itself. 72% of all silver came not from silver mines, but as a byproduct of copper, lead, and zinc operations. When a company digs for copper, silver comes along for the ride. It's extracted, refined, and sold. But the decision to mine isn't based on silver prices. It's based on copper prices. This created a structural problem. Silver demand could surge. Silver prices could double. But if copper prices stayed flat, no new mines would open. The supply response that normally stabilizes commodity markets, higher prices attracting new production, didn't function properly for silver. A geological survey published in late 2025 showed that global silver reserves, the amount economically viable to extract at current prices, had decreased by 11% since 2020. Not because reserves were depleted, but because what remained was deeper, lower grade, and more expensive to process. Meanwhile, on the demand side, something unprecedented was happening. In Stuttgart, Germany, an automotive engineer was redesigning the electrical system for a new electric vehicle platform. Each vehicle required 1.2 ounces of silver in various components. Contacts, switches, circuit boards, battery management systems. The company planned to produce 400,000 units annually. That was 480,000 ounces of silver every year, from one model, from one manufacturer. Across the global automotive industry, the transition to electric vehicles was creating silver demand that hadn't existed 5 years earlier. Some analysts estimated the EV sector alone would consume 90 million ounces annually by 2030, but the automotive sector was secondary compared to solar. In Jiangsu province, China, a solar panel factory operated around the clock. Every 18 seconds, a completed panel rolled off the production line. Each panel contained approximately 1 ounce of silver paste, screen printed onto silicon wafers to conduct electricity. 1 ounce, every 18 seconds, 24 hours a day. The single factory consumed 1.75 million ounces of silver per year, and it was one of 47 similar facilities across China. The International Energy Agency had published projections showing that to meet global climate commitments, solar installation capacity needed to triple by 2030. If those projections held, solar panel production would require 250 million ounces of silver annually. That was more than a quarter of global mine supply, going to one application, in one industry. And substitution wasn't simple. A materials scientist at MIT had spent 3 years researching alternatives to silver in photovoltaic cells. Copper paste could theoretically work. Aluminum had been tested. Carbon nanotubes showed promise in laboratory conditions. But in commercial production, at scale, in real-world efficiency requirements, silver remained unmatched. Its electrical conductivity was the highest of any element. Its reflectivity, essential for certain panel designs, couldn't be replicated. And critically, the manufacturing processes had been optimized around silver for 2 decades. Switching would require retooling entire factories, retraining workforces, and accepting lower efficiency panels. At $30 silver, substitution made no economic sense. At $50 silver, it became marginally viable in some applications. At $75 silver, manufacturers would seriously explore alternatives. But alternatives took time. Years, not months, and demand wasn't waiting. A telecommunications analyst in Seoul was calculating silver requirements for 5G network infrastructure. Each 5G base station required approximately 6 ounces of silver in circuitry and connectors. South Korea alone planned to install 230,000 stations by 2027. That was 1.4 million ounces for one country's telecom build-out. Globally, 5G infrastructure was projected to consume 40 million ounces through 2030. Every industry driving the modern economy, renewable energy, electric transportation, digital communications, was simultaneously increasing silver consumption, and almost none of it was discretionary demand that could be delayed during shortages. A government analyst in Washington reviewed strategic stockpile data. The The United States maintained reserves of dozens of critical materials. Helium, cobalt, rare earth elements. Silver wasn't on the list. The strategic stockpile had been eliminated in 2005 when silver was considered abundant and commercially available. China's stockpile data was classified, but import records told a story. Over the previous 18 months, Chinese entities had imported 180 million ounces more silver than their industrial consumption required. That metal was going somewhere, either into manufacturing inventories, government reserves, or private accumulation. But it wasn't leaving China. The mining engineer in Peru filed his quarterly report. Production down, costs up, ore grades declining. The automotive engineer in Germany placed orders for silver contacts. Lead time, 14 weeks. Previously, it had been 4. The solar factory manager in China received instructions to secure 6 months of silver inventory. Previously, they operated on 30 days. And in offices across the Western financial system, analysts were beginning to ask an uncomfortable question. If mine supply couldn't increase, if industrial demand was accelerating, if Eastern buyers were accumulating rather than trading, where would the silver come from when the paper contracts demanded delivery? The answer wasn't in the spreadsheets. It was in the vaults. And those vaults were emptying faster than anyone wanted to admit. In a vault beneath the streets of London, a bullion manager walked through rows of silver bars and noticed something that hadn't happened in his 20-year career. The allocated section, metal owned by specific clients, was full. The unallocated section, metal available for general trading and delivery, had shrunk to its lowest level since 2011. The ratio had inverted. Clients were converting paper claims into physical metal at a rate that suggested they no longer trusted the paper. This was the beginning of price discovery, not the price printed on trading screens, not the price quoted by futures markets, but the real price, the price someone actually pays to obtain physical metal they can hold, store, and control. And that price was diverging. A hedge fund manager in Connecticut had been watching trading volume on COMEX silver futures. Daily volume averaged 180,000 contracts, representing 900 million ounces of silver changing hands electronically. But COMEX warehouses held only 280 million ounces of total inventory, and only 82 million ounces were registered for delivery. The math revealed something extraordinary. Every single ounce of deliverable silver was being traded 11 times per day on paper. This level of leverage worked fine as long as everyone agreed to settle in cash. But the moment significant numbers of contract holders demanded physical delivery, the system broke. It wasn't designed to deliver, it was designed to trade. An economist in Singapore had been tracking what he called flow patterns, the movement of physical silver between regions. His data showed a consistent one-way flow: silver leaving London, silver leaving New York, silver arriving in Shanghai, Mumbai, and Dubai. Western investors were selling ETF shares. Eastern buyers were taking delivery of bars, month after month, without reversal. This represented something deeper than a trade. It represented a wealth transfer. Physical metal flowing from regions that treated silver as a speculative asset to regions that treated it as strategic inventory. At artificially suppressed prices, the COMEX price of $71 assumed unlimited supply at that price, but the Shanghai premium of $78 revealed the truth. Physical silver was scarce, and those who needed it were willing to pay more. The question was how long the paper price could remain disconnected from physical reality. A precious metals analyst in Zurich had constructed a model based purely on supply and demand fundamentals. No speculation, no monetary theory, just industrial consumption versus mine supply. His model showed a deficit of 140 million ounces in 2026, meaning demand exceeded new supply by that amount. The deficit had to be filled from above-ground stocks, existing inventories, scrap recycling, and previously held reserves, but those stocks were finite. His model projected that at current consumption rates, without price rationing to reduce demand, available above-ground silver would be functionally depleted by late 2027, not gone entirely, but unavailable at prices the paper market assumed. Then he added a second calculation. Silver's historical price relationship to gold averaged 60.1, meaning 60 ounces of silver equaled 1 ounce of gold. At current gold prices, near $2,700, that ratio suggested silver should trade at $45. But history showed the ratio could compress dramatically during monetary stress. In 1980, it briefly touched 15:1. In 2011, it reached 32.1. If the ratio compressed to 41, silver would be $67. At 31, silver would be $90. At 25:1, silver would be $108. These weren't predictions. They were scenarios based on historical precedent, and every scenario put silver substantially higher than current prices. A portfolio manager in Boston was reading a report from his commodity desk. It outlined 3 potential paths forward for silver prices. Path 1, orderly repricing. Paper markets gradually acknowledge physical scarcity. Prices rise 40% over 18 months to better reflect supply-demand fundamentals. Industrial users adjust. Some substitution occurs. Market stabilizes at a higher equilibrium. Path 2, disorderly repricing. A delivery default or margin crisis forces rapid price discovery. Silver spikes to $65 to $80 in weeks, not months. Volatility explodes. Some leveraged positions fail. Eventually stabilizes, but at permanently higher levels. Path 3, complete breakdown. Loss of confidence in paper pricing mechanisms. Physical and paper prices separate entirely. Cash settlement becomes mandatory for most contracts. Physical metal trades at substantial premiums to official prices. Market fragmentation persists until new pricing mechanisms emerge. The report didn't assign probabilities, but it noted that Path 1 required cooperation from all market participants. Path 2 required only one significant failure. Path 3 required only loss of trust. Trust was already eroding. In Geneva, a private bank that stored physical precious metals for wealthy clients reported something unusual. Withdrawal requests for silver had increased 340% in 6 months. Not to sell, to relocate. Clients were moving silver from bank vaults to private storage, from allocated accounts to personal possession. This was the behavior of people who no longer trusted the system. A monetary historian reviewing the patterns saw echoes of 1971, when French officials demanded physical gold for their dollar reserves, triggering the collapse of Bretton Woods. The mechanism was the same. Paper claims exceeded physical availability. Confidence eroded. The gap couldn't be sustained. Price had to adjust, or the system had to change. For businesses dependent on silver inputs, the strategic implications were clear. Waiting for price confirmation meant waiting until everyone else recognized the shortage. By then, securing supply would be exponentially more difficult and expensive. Early positioning meant paying premiums now, but guaranteeing access later. For investors, the decision tree was simpler but not easy. Physical silver offered no yield, required storage, and could experience volatility, but it also couldn't be printed, couldn't default, and couldn't be diluted. In an environment where paper claims exceeded physical metal by ratios that defied basic accounting, physical possession eliminated counterparty risk entirely. The bullion manager in London locked the vault and returned to his office. His job was managing metal, not predicting prices. But after 2 decades in the industry, he recognized when market structure was breaking. The warning signs were everywhere. Persistent premiums, declining inventory, one-way flows, ratio distortions, leverage extremes. Whether silver reached $100 wasn't the critical question. The critical question was whether the current pricing mechanism could survive the collision between unlimited paper claims and finite physical metal. History suggested it couldn't. Physics guaranteed it wouldn't, and time was running out to position before the market discovered which of those forces would prevail. The spreadsheets showed $71. The vaults told a different story, and in the end, metal doesn't lie. The data is clear, the mechanism is documented, the timeline is compressing. This isn't speculation, it's structural analysis of a market approaching failure. Whether you hold silver, trade silver, or simply need to understand what's coming, the next 6 months will determine which price was real. If this analysis provided value, share it with someone who needs to see it. Until next time, stay informed, stay positioned, and stay ahead.